Good evening, everybody. My name is Daniel Young. I'm the owner and founder of Adaptive Perspective. Uh, this is going to be a slightly different opening because I've reworked my mission statement, my why. And after 45 videos, let's just say I need to try a little. I need to try some things new. So my purpose is to help you identify your dreams and make them your reality. So these videos talk about portfolio income achieved through closed-end funds and how the system is different than most of the other advice channels floating around. Like the vast majority of those memes I reference in the other videos. So, different how? We're building a portfolio with the goal to retire or supplement a retirement through dividends instead of slowly selling off the portfolio. So, if we target dividends and not the traditional 2% dividends and those low ball dividends, not that. I'm talking 9% dividends. So if we target those styles of dividends, we can keep that principal fund or capital investment and then earn dividends and then either reinvest those dividends or cash out those dividends and live off that. So the principal stays invested and we live off dividends. So how do we do that? Let me show you. So share my screen. This is our closed-end fund, our closed-end fund master, and it is a compendium of sorts. It's a Google sheet of lots of different information. It's got flag companies we track, the master of all current 433 closed-end funds that was updated yesterday. I update this entire sheet once a month. I update every color coded section. So maybe not the gray, but between blue of what we own, purple of what others have recommended, and green, I update once a week, generally on Saturday morning. Gray does not fit the mold. Yields under 6 or more than $16. Right. And currently across all closed-end funds, so there's 435 lines minus the 2 at the top, that's 433. So across all 433 closed-end funds, the current average yield is still above 8.5, which is insane because you don't find that with single companies, or you find that seldom with single companies. So the best way to sort this data and then offload it. Why would we do that? So closed-end funds flags, like the companies of note, the master, all the funds, our stock, our portfolio from last year, our dividends from last year, our existing portfolio, gray's been sold. So our existing portfolio and the individual days when we've bought stuff, our current dividends. This is what's scheduled or anticipated for the year. So if we end up buying something, let's see, like this was added. All right. So if we end up buying another batch of this, it would get its own line, and then the dividends would start on the next dividend cycle. Right. So that's what we're expecting for the year. But this is also the running total. So this is what's been paid so far for the year. This was paid last year. This was paid our first year doing this. And then this is the total so far. Right? Running total so far. Excuse me. And then these videos are the past videos and correlate to what's been posted on Pinterest and or not Pinterest, YouTube. And this one's blank. So let me switch back. So this video is an unedited video. So who knows what you hear in the background? It's generally my house cat witching hours. So who knows if he'll be out and about. Disclaimers. if you want the full disclaimers, read the description. The only two I'll really say here are that I am not a financial advisor. I'm a financial strategist. And then the second is I don't speak like the herd. I walk in limited company, and sometimes I walk alone, and I'm okay with that. And I say I don't talk like the herd because I'm filming raw video in my house with who knows what you hear in the background because that's real and that's transparent to me. It's not me shipping this off the Fiverr and finding some video editor to edit videos weekly or monthly, and then making it look all clean and pristine because that's not the everyday average person. And not to say that we're all average, but that's not the everyday person. I wanted something more tangible, something very transparent, something very relatable. So, all right, let's get back to this. So we have this giant database. How do we sort the data? Right? Because all the funds, they all have prices, they all have dividends, they all have yields. Some yields are zero, some are crazy high. How do we really sort the data? In closed-end funds, it's a limited number of shares. So it's truly supply and demand, right? So when share totals shrink, right, and the supply decreases, then the price goes up, and then the same is true vice versa. Like if total number of shares goes up, people sell, right, and then price say supply and demand. So when everything is plentiful, prices are lower. When everything is not plentiful, prices are higher. And in a closed system, closed-end fund, that works. That doesn't work with Coca-Cola or Johnson and Johnson or any single entity in that regard, because if they ever ran out of shares, they could honestly hand you a sticky note out of thin air that says one share, and it wouldn't impact the price of everything else. So the best way to sort this and filter this first is by discount. So think of it like buying, think of it like buying a dollar candy bar, which I know most candy bars are not a dollar, right? But think of it like buying a dollar candy bar. You're getting your dollar candy bar at a discount. And pending your level of discount, like we'll use this one, it's 40% off. So instead of paying a dollar, you're paying 60 cents. Sorry, something random on my keyboard. So with the market up and down and nobody really knowing, I really hope this didn't just restart and start over. Like the whole intro is gone because it randomly resynced. I hope not, but I'm just going to keep going as is. I hope not. So let's try this again. So when no one knows what's going on, right? When the best predictions are, I don't know, then it makes it harder, to be honest. It makes it easier and also makes it harder. It makes it harder if you're trying to target specific investment platforms. It makes it harder if you're looking for specific companies. It makes it easier if you can identify companies based on discount, because we're looking at historical discount. So yes, it's 40% off, right? That sounds like an amazing deal. And in this case, it is. We use this one. So this fund comes recommended, but it doesn't make my list based on its yield. So the discount is like, we'll say 19% off. So in our dollar candy bar, that's like paying 81 cents instead of a dollar. That's a good deal, right? But historically, The discount is near 10%. The last 5 years, it's at 16%. It's not double. Now, it's greater than that 5 year average. That's true. It's also not double the historic discount. And what we're trying to do here is filter out all the discounts. So the buy alerts are double the historical or double the 5 year discount, right? Or both. And then they're finally below premium. Like if a fund generally sells for more than it's worth and then suddenly drops into some type of discount, that's a good deal. Just doesn't look like a good deal because this fund is selling for 40% off. So, and that's kind of my take. Like you have people saying, hey, you should invest in bonds, you should invest in this, you should invest in that. And I'm really only going to suggest two things today. For me, it's tempting because I've been trying to uh, raise certain stocks in our portfolio, and this is tempting because this is close to that average. So currently, it's at 17.3. We'll say 5 year historic would be like 17.6. That's close. 17.7. That's close, right? And then it would be significantly greater than the historical. But because we have so many good options on the discounts that actually meet those standards, even though it's like maybe a 0.5% difference, it's still a 0.5% difference. So if I was investing tomorrow morning, where would I put money? So I can further demonstrate what we're targeting. These are all the different targets. Right, so where's the line? That's 30, so that's 28 different funds. Now we're not looking to buy anything we don't already have. So we own everything in blue, right? So I could get rid of all these color-coded things. Here, we'll put it where it goes. It goes here. Current is what we currently own. I like to look at current stuff when we buy things. So is there an easy way? Kind of. It's not to say these aren't great companies, but we're not looking to buy something we don't already own. Okay, so then I can come back. All of these, let's see, are they all at a discount? Yes. And like this, USA is generally premium. So currently it's selling for a discount and it's got an obscenely high yield over 10. But it pays on this off quarterly fashion, which isn't my favorite. It's also an automatic dividend reinvestment, meaning they pay you and then they take the money back and give you more shares. It's not like money I can actively invest myself, which is not my favorite thing either. So we have 15 current funds, so minus two, so 13 current funds that are all crazy discounts right now relative to their historical data. All that said, if it's me and I'm investing tomorrow morning, there's really only two funds I would target, which I'll get to. But I'm going to screen, well, here, if you're interested in yield, right, or we can go reverse, right? There's some crazy high yields right now. But if where I would go, I'll put in where I would go is here. Like it's hard to pass by that great of a discount. I mean, that's your dollar candy bar selling for 40 cents off, 40% off. So you're paying 60 cents for every dollar invested. That's crazy. And if you've never heard of this company before, I don't fault you because not many people have. Um, of the articles I read, I'll let y'all read this highlighted section. It comes off of my paid membership with the Contrarian Outlook. And between Brett Owens and Michael Foster and their team, they talk about single stocks, but they also talk about closed-end funds. And this was written about HFRO back in May of this year. So pause the video, read the highlighted part in blue, right? And then really look here, because back in May, it was 38% off, right? Which is close to 40, but not 40, right? So even if the price closed by 20%, you would still get this fund 20% off, which is still great. Now that would move it to second on the list behind its sister fund. But of the options, did I lose? Nope, there it is. As much as I like the USA fund, of the options for tomorrow, I would trim everything down to these two. So HFRO, if you look on Morningstar and just look at the division of funds, um, you've got people I read from the Contrarian Outlook pushing bonds. Uh, you've got others pushing technology. You have others pushing the housing market, saying that housing and industrial real estate is due for a resurgence. And my take on both of those. So if I'm going to invest in bonds, I mean, I would love to invest in a company that owns bonds, and that would be the way to go if I'm going to follow that advice. But more than bonds, oil drives our economy. So to play the closed-end fund game and to follow all the rules and to adhere to the principles, I would be a fool to discourage you or push you away from taking this 40% off, because that's crazy. It's been at 40% off before, and then it's kind of scrolled down to the mid 30s, and then it ticks back up. And 40% off on a fund that has paid say currently it's like around 11, but it's been a little bit higher, a little bit lower, but around 11% yield, or this cost a dividend for several years consistently is foolish of me. Gosh, I mean, 40% off. And why not the others? Because it was not at the top of the list, right? Let's go back to, so I can't find much on, like, there's information on DMA, but there's conflicting information on DMA. It's been restructured. It's got this high discount. It's fluctuated a little bit. It's actually a little lower than it has been. It's at 50% for forever. It, yeah, there's too much unknown. I'll put it that way. The second one is annual. I want something more consistent. Now, quarterly would be more consistent than once a year, but monthly is ideal. And that's where HFRO sits third. It pays monthly. Based on this buy-in price, it's 11% gain or 11% yield monthly. And then you get it at 40% off. So on that dollar candy bar, it's like paying 60 cents. That's crazy, right? I could say DNIF, another great fund. It meets the standard, right? On our end, I've been trying to keep yields above 9, which sounds crazy perhaps if you're used to 2 and 3% yields, but I've been trying to keep ours above 9. And what that's done is helped keep our overall yield at 10%, which is a safe 10% in this market and with closed-end funds. Now, some are higher, some are lower. All right, this is category 3 on our page. So it's just base 3, 6, 9, 12. You've got some that are higher and lower here. Right? So by category, it's 9.7. Lower, right? But there we go. But 10% is a comfortable, safe 10% in this environment. And 11% is a comfortable, safe dividend in this environment. So I would be a fool to tell you to look away from this discount. And DNIF, yes, amazing thing, same thing, lower yield than I would like, but it's category 3. But I'm going to kind of come back to that version in a little bit. HGLB, a sister to HFRO, they just manage fewer overall funds. Same thing, significantly different on the discounts. Crazy discount, meets the metric, meets the 9% or greater, currently a great buy. Where I would go different is that, so I would buy the top discount, and then I would go with oil, energy transfer, and utilities. And that's the other thing displayed here. So in just 48 funds and 1.8 billion of total assets, and you get to see their top 24 funds here, they are well placed. They're diversified within that master limited partnership of oil, natural gas, utilities, energy transfer. So everything in our economy is built on oil. You could say, hey, we should do technology. Well, those are all oil byproducts. Like we manufacture all the technology, this laptop, this mouse, my phone, that power bank, that CD, right? All of that is from an oil derivative. You could pick infrastructure. All of that's an oil derivative. Bonds are its own thing. But much of our society is oil based, whether you think oil should be in existence or not. You could be like, every car should be electric. Well, on the forefront of what you see, the majority of the car you're driving is built from an oil byproduct. Still takes a battery. That battery has to be charged. And while you might plug it in at your house, right, you're not filling it up at the pump, somewhere in the system that has to come from a power plant that still uses oil or coal or nuclear energy to power the battery inside your oil-based and oil-built car. So pacemakers, crutches, computers, at least half the stuff in your house is built with an oil byproduct. So for our society, culture, and world to exist without using oil is not possible. Oil powers the world. And currently, of the 3 oil funds we have, FEI, NML, well, 4. So FEI, NML, KYN, and KMF. KMF and KYN will supposedly merge, with KYN being the surviving member. Of those 3 funds, KYN is priced. FEI meets the target discount too. It doesn't quite meet the yield standard. It also hasn't raised its dividend, whereas NML and KYN and KMF have all raised their dividends since the 2020 lockdowns. And it's priced to sell. It's normally in that 10 to 11 range. It's currently just below 9. It's been on the lower 8s. targets wise, discount wise, it's a significant difference between 40 and 13. I get that, but that's why we have to compare this discount to this individual fund's historical data, right? So historically, at 5 years, it's almost 12, so it's more than that. And for the life of the fund, there is no discount, right? And that's significantly different than 13. But I, I think this is a great long-term play. 40, 50, 60, 70 years, however long, oil will always be needed. Regardless of what society thinks powers their car, oil will always be needed. And this fund, this very misunderstood fund, I think will become more well known as this discount survives. Even if it goes down to 30%, it's still a great deal. So if you look at like 6 weeks ago, yeah, 6 weeks ago, there were all these different options based on the current temperature of the market. 5 weeks is shortened. 4 weeks is about the same. 3, right? This week is really just 2. It's this insanely discounted company who pays an amazing dividend at a great yield and Energy Transfer and Oil. I mean, here to stay, whether you like it or not. So those are my picks for the week. Really 2. I mean, it used to be 3 and 4, sometimes 5, but this week just 2. So if you like the content, consider subscribing to my channel and then head over to Facebook and join my group there called Navigate Your Finances. And the link will be in the description. That is, if YouTube allows it, it might just tell you how to find the group on Facebook. And then in your game of things, right, in your scheme of things of where you are and where you want to go, you're the captain of your ship. You're going to steer the ship wherever it needs to go, hopefully, right? But bare minimum, it's going to be steered wherever you want the ship to go, right? And if you get distracted, if you take a joy trip, right, you're still going to steer the ship, right? So be mindful. You're the captain of your ship. You have the power to change your life and your financial future. Many people will offer to help you, but only you can make the choice to do it. So steer your ship where it needs to go, even when it's hard, even when it's tempting, even when it's easy. Steer the ship where it needs to go, right? And then make it happen. Shock your world. This is Daniel Young signing off. I will see y'all on another video. Bye-bye.